What happens when the people you trust with your money turn out to be lying? When massive corporations, respected investors, and even entire financial markets are exposed for being built on a lie? Enron, Bernie Madoff, FTX, three names that have become synonymous with some of the biggest scams in history. But how did these giants fall from grace? And what did they leave behind? In this story, we uncover the dark side of the financial world that most of us never see. And we ask, could something like this happen again? Enron. Enron was more than just a company. It was a symbol of success in the 1990s. Innovative, ambitious, and at the heart of the energy market. Founded in 1985 by Kenneth Lay, Enron quickly grew to become one of the largest energy companies in the world. By the late 90s, it was seen as a revolutionary company, pushing the boundaries of what was possible in energy trading. But behind all the gloss and glam, there was a secret brewing. Enron wasn't just a company, it was a giant built on a carefully crafted illusion. The company's real financials were a far cry from what was reported to the public. Enron used complex accounting tricks, such as special purpose entities, SPEs, to hide debt and inflate profits. It looked like a highly profitable business on paper, but in reality, the company was drowning in debt. In 2001, after years of deception, the truth started to leak. The stock price, which had been skyrocketing, suddenly plummeted. Shareholders lost billions. Thousands of employees lost their jobs, savings, and retirement funds. Enron filed for bankruptcy in December 2001, marking one of the biggest corporate collapses in U.S. history. The scandal destroyed lives, led to the downfall of the accounting firm Arthur Andersen, and shook the very foundation of corporate America. The Enron scandal. The truth was ugly. Enron's executives, particularly CEO Jeffrey Skilling and CFO Andrew Fastow, had been hiding debt off the balance sheet, making the company appear far more profitable than it was. They also created fake assets and manipulated their financial reports, fooling everyone from investors to analysts and even their auditors. Enron's stock was overvalued by over 50% at its peak. When the company finally collapsed, it wasn't just the stockholders who suffered. Employees who had invested their retirement funds in Enron stock saw their life savings wiped out, and the impact didn't stop there. The scandal shook investor confidence across the country and sparked outrage. This event led to major changes in corporate governance, including the Sarbanes-Oxley Act of 2002, which aimed to prevent such corporate fraud in the future. The message was clear. Deception on this scale wouldn't be tolerated. Bernie Madoff. Bernie Madoff's name is now synonymous with the largest Ponzi scheme in history. A former chairman of NASDAQ, Madoff was a respected figure in the world of finance. He promised investors steady, high returns, claiming he had a foolproof strategy for generating profits. But it was all a lie. Madoff's investment firm was built on an illusion. For decades, Madoff ran his Ponzi scheme, paying returns to older investors with money from new investors. It worked because people believed Madoff, and he surrounded himself with influential people, which kept the scam going. No one suspected a thing until the financial crisis of 2008. When the markets crashed, investors began asking for their money back, but Madoff didn't have it. In December 2008, the scheme unraveled. The total losses were staggering, about $65 billion, although some experts suggest the true losses were even higher. Madoff was arrested, and in 2009, he was sentenced to 150 years in prison. The Madoff scam. The Madoff scandal was different from Enron's. It wasn't a company inflating its numbers. It was a massive fraud that fooled some of the most experienced investors in the world. Madoff's scam had been going on since the 1970s. The beauty of his scheme was its simplicity. He promised consistent returns, no matter what, and for decades, he delivered. But when the financial crisis hit, everything collapsed. The money ran out. Thousands of people lost everything: celebrities, charities, even pension funds. Madoff's scheme destroyed lives and reputations. Many of his victims had trusted him because of his pedigree. The fact that such an influential figure could pull this off without being detected for so long was a wake-up call for the financial world. FTX. FTX seemed like the future of finance. Founded in 2019 by Sam Bankman-Fried, FTX quickly rose to become one of the largest cryptocurrency exchanges in the world. The company attracted high-profile investors, endorsements from celebrities like Tom Brady, and even partnered with major sports leagues. It was the go-to platform for crypto trading, with a valuation of $32 billion in 2022. But the rise of FTX was built on shaky foundations. Sam Bankman-Fried had transferred customer funds from FTX to his trading firm, Alameda Research, without telling anyone. This created a massive liquidity problem. In November 2022, the truth came to light after a report from CoinDesk raised questions about FTX's finances. Within days, FTX was facing a liquidity crisis, and by the end of the month, it filed for bankruptcy. The FTX collapse. FTX's downfall wasn't due to bad investments or unfavorable market conditions. It was a result of reckless management and outright fraud. Sam Bankman-Fried, the founder, used customer funds for high-risk investments without properly informing anyone. When the market turned against them, FTX couldn't cover its massive liabilities, and the whole operation collapsed. The failure devastated millions of customers, employees, and investors, many of whom lost everything. The damage wasn't just financial, it shattered trust in the cryptocurrency space. Bankman-Fried was arrested, later convicted of fraud and conspiracy, and faced significant legal consequences. The collapse of FTX sent shockwaves through the entire cryptocurrency market, further exposing its vulnerabilities and the need for tighter regulations. This disaster made it clear: the crypto world needs stronger oversight to protect investors and prevent similar disasters in the future. Comparative analysis. What connects these scams? Deception. All three were built on lies. Enron's false financial statements, Madoff's fake returns, and FTX's mismanagement of funds were all kept hidden from the public for years. Each of these scams was carried out by individuals at the top of their respective industries, who used their position and influence to maintain the illusion of success. In each case, regulatory bodies failed to act in time, and the damage was catastrophic. These scams didn't just ruin companies, they ruined lives. Investors, employees, and entire communities were left in the wreckage. Lessons learned and preventive measures. The biggest takeaway from these scandals is simple: don't trust everything you see on paper. Whether it's a company's financial report, an investor's promises, or a shiny new financial system, transparency is crucial. If something seems too good to be true, it often is. This means investors need to be diligent, always researching and verifying before committing their money. These scandals also highlight the need for stronger regulations. In the wake of Enron, the Sarbanes-Oxley Act was introduced to improve corporate accountability and prevent similar frauds. But these measures are just the beginning. The financial world needs watchdogs that are willing to challenge the status quo and question even the most powerful players, especially when something doesn't add up. The system must work for the people, not the other way around. The ongoing impact. The aftermath of these scams is still deeply felt today. Enron's collapse changed the way people view corporate ethics and led to stricter regulations, like the Sarbanes-Oxley Act, aimed at preventing such corporate fraud. Madoff's Ponzi scheme remains a chilling reminder of how easily trust can be manipulated. His scam destroyed lives and left a lasting mark on the financial industry, forever altering how we view high-profile investors. FTX's failure sent shockwaves through the cryptocurrency market, highlighting the urgent need for regulation in the crypto space. It triggered widespread calls for greater oversight to prevent similar disasters. While some victims have received compensation, the scars are still visible. Trust in financial markets has been shaken, and regulatory reform is more important than ever. The lessons from Enron, Madoff, and FTX continue to shape how investors and regulators handle risk today. Enron, Madoff, and FTX were more than just financial failures. They were catastrophic events that changed the world of finance forever. They show us the power of deception, the dangers of unchecked ambition, and the importance of transparency. As we look back on these massive scandals, we can't help but ask, what has changed? Are we more cautious, more aware, or are we still vulnerable to the next big lie? If you learned something new today, don't forget to comment below, share this video with your friends, and hit that subscribe button to stay up to date with all our content. And make sure to press the bell icon so you never miss a video. Let's keep the conversation going.